Hi, I'm Lary Wolf, and this is Stuart Gross. We're partners at the law firm of Roberts and Holland, and we've been talking about the new tax law. We went through the deduction for qualified business income, which allows it up to a 20% deduction. We're now going to go through an example that illustrates how this formula works and how the deduction can be computed. So our example is we have a business, it's one business that has receipts of $4 million, has wage expenses of $800,000, has other expenses of $600,000, and it owns qualifying property, depreciable property, with an original cost of $10 million. So the net income from this business is $2,600,000. That is the receipts of $4 million minus the wage expense and the other expenses of $800,000 and $600,000 to get to net income of $2,600,000. And we're going to assume, for purposes of this example, that all of the income is QBI, qualifying business income.
So 20% of $2.6,520,000.
Right. That would be, if that, it's that simple. 20% of the QBI is 520,000. So the deduction, to go back, is equal to the lesser of 20% of QBI, that $520,000 number Stuart just alluded to. So it's the lesser of 520,000 or the greater of 50% of the W-2 wages, which we said were 800,000 times 50% is 400,000, or 25% of the W-2 wages plus 2.5% of the basis of the property. So 25% of the wages is 800,000 times 25% is 200,000, plus $10 million of qualifying basis times 2.5% is 250,000. So 200,000 plus 250 is 450,000. So we had three numbers. First was 20% of the qualifying business income, 520,000. So if that's the lowest number of these three, that's what your deduction would be. But in our example here, 20%, 520,000 happens to be greater than the greater of the two items. 50% of the wages was 400,000, and the combination of 25% of wages and 2.5% of basis was 450,000. So the greater of 400 or 450, 450,000 is our second part of the equation. And since that's less than 20% of the qualifying business income, the deduction is 450,000. Simple.
So I get the deduction up to the greater of 50% of the wages plus, or 25% of the wages and 2.5% of the qualifying basis. Okay, I think I got it, Larry.
That was good, Stuart. Let's assume for the moment that this business is conducted in a partnership with the same numbers, and assume we have partner A, who's a 5% partner, and assume that that partner has $20,000 of taxable income unrelated to this business. His share of the income from the business is $130,000, 5% of $2,600,000. So his total taxable income would be $150,000, 20,000 of unrelated taxable income plus 130,000 of qualifying business income. Total 150,000. His qualifying business income is 130,000. 20% of that is $26,000. Okay, so do I have to go through this complicated formula? Not for this partner. Why? Because his taxable income is below that $157,500 threshold. So once you're below that, it doesn't matter what business you're in. You can be a lawyer, an accountant, a doctor, whatever, anything you want.
Anything other than an employee.
Anything other than an employee, and you don't have to go through the wages and the basis of property computation. So partner A, a 5% partner, on these numbers would have a $26,000 deduction, and this deduction reduces taxable income. The 95% partner, when you go through the numbers, he's well over the $157,500 limit, threshold. So we have to work through, he has to worry about wages and basis and 20% of qualifying business income. So for him, when you go back to the example we went through, that the deduction was $450,000, he would wind up with a deduction of 95% of $450,000, or $427,500. So what we've concluded here is, depending on your income level and the type of trade or business, you can get very different results. So the person who's in a manufacturing business gets a better result than a person who's in an accounting firm. Why this is, I can't explain, but that's what Congress came up with.
It's worth adding that the $157,500 and $315,000 numbers do have phase-outs. If you're $50,000 above the $157,500, the benefit of not being subject to the various W-2 limitations, complicated formula, and the carve-out for the bad businesses, the specified service businesses, after $50,000 above the $157,500, you're fully subject to the limitations, and you can no longer get the benefit if you're a specified service. And that's a $100,000 number with respect to $315,000. The phase-out calculation is not simple, but you should understand that it's there.
It's